After some time in trading, investors often realize that although we know, we still make this mistake frequently. In other words, you know, but you don't understand. This indicates that we have not yet awakened or become enlightened in trading. Investment trading is a battle between psychology and reason. When traders face the rapidly changing market, they are inevitably influenced by internal fluctuations. Every market fluctuation creates ripples in our hearts, affecting our judgment of buying and selling opportunities and leading us to make many impulsive decisions that are not well thought out. Jesse Livermore, the trading genius, often mentioned that the success or failure of trading depends on whether one can overcome inner fears and greed. In today's world filled with excessive information and market noise, this ability to control oneself becomes even more important. Today, we will discuss a simple but extremely effective trading rule that can help you avoid making impulsive trading decisions: the 24-hour cooling rule. Imagine this. You just saw a stock rise by 10% due to some news, and you happen to have some funds available. Your brain is instantly filled with greed, and you impulsively decide to buy immediately. At this moment, you may feel that your judgment is impeccable, and the market sentiment seems to support your decision. But if you calm down and wait 24 hours before making a decision, your inner state and the market's fluctuations might be completely different. The 24-hour period helps you avoid making emotional trading decisions. The essence of this rule is to give yourself a cooling-off period, avoiding making decisions that are easily influenced by emotions in a short time. Jesse Livermore repeatedly emphasized that the hardest part of trading is controlling one's emotions, especially when faced with short-term market fluctuations. Every market fluctuation is a psychological pressure, forcing traders to constantly swing between desire and fear. Calming yourself down and temporarily putting aside the urge to act hastily is the key to investment success. The application of the cooling-off rule can be understood from two levels. 1. Avoiding emotional decisions. The stock market is a highly volatile market. Every day, stock prices fluctuate dramatically due to news events, earnings reports, political factors, etc., especially when these fluctuations trigger emotional reactions in you. You might feel anxious or excited when you see a stock fluctuate significantly and feel an urgent need to seize this opportunity. But such emotions often make you overlook the fundamentals and make hasty decisions. The cooling-off rule gives you time to reassess the market conditions and rationally evaluate whether it is worth entering. For example, suppose you see a company in the US stock market announce a major merger deal, and its stock price rises instantly by 10%. Driven by market enthusiasm, you might think this is an opportunity you cannot miss and quickly click to buy. But you forget that the surge in stock price might hide the high-risk uncertainty of the merger. After 24 hours, when the market's heat cools down, you'll find that the stock price has corrected, and your impulsive trade has thus avoided unnecessary losses. 2. Rational judgment of buying and selling opportunities. In his trading career, Jesse Livermore always emphasized, "Go with the trend." He believed that successful traders must have the ability to quickly identify market trends and make rational buy and sell decisions based on these trends. However, he also knew that trend judgment must be based on objective analysis, not driven by emotions. Therefore, the cooling-off rule requires you to give yourself 24 hours to rationally think about the market's direction. During this period, market information will be more fully digested, and you will be able to more clearly judge whether the market is truly in a favorable buying or selling position. By observing common trading behavior patterns, It's easy to see that many losing trades are often caused by excessive impulsiveness. For example, many investors, when the stock price falls, often sell quickly due to fear and end up missing the rebound opportunity later. Others, when the stock price rises, due to the urge to chase gains, miss the best selling opportunity. The cooling off rule can help you avoid these impulsive decisions, ensuring that you can examine the market from a higher perspective and make the best trading decisions. In the Chinese stock market, similar cases can be found. For example, some investors in the A-share market see a stock surge due to a news event and rush to follow it, buying at a high price, only to suffer huge losses when the stock price corrects. After 24 hours of calm reflection, they might realize that the stock price increase was more about short-term market sentiment rather than a fundamental change in the company's fundamentals. At this point, they can choose to wait for a price correction before making a decision, thus avoiding mistakes caused by emotional reactions in the stock market. How to incorporate the cooling-off rule into your trading plan? Incorporating the cooling-off rule into your trading principles isn't difficult. First, you need to set a clear cooling-off period for yourself. 24 hours is not absolute, and you can adjust it based on your trading rhythm and market conditions. Second, before trading, you can write the cooling-off rule into your trading plan. The cooling-off rule is not only applicable to the stock market, but also effective in other financial markets, whether it is the futures market, foreign exchange market, or cryptocurrency market. Emotional trading is a common problem faced by investors. The cooling-off rule helps you stay calm under pressure and avoid mistakes caused by impulsiveness. Summary: the core of investing is self-discipline. As Jesse Livermore said, the stock market doesn't always develop in the direction we expect. Successful traders are not those who can predict market fluctuations, but those who can remain calm and patiently wait for the best opportunities. The cooling-off rule is a natural extension of this idea. It reminds us that trading is a long-term battle, not a short-term impulsive action. In the volatility of the stock market, emotions are often the greatest enemy of investors. The cooling-off rule helps you overcome this enemy, stay calm, and avoid making mistakes due to momentary market fluctuations or short-term emotional reactions. By giving yourself a cooling-off period before each trade, you can not only enhance your rational judgment, but also increase your chances of long-term success in the market. Whether you are a novice trader or an experienced investor, learning this rule and rejecting impulsive trading will allow you to stand out in the complex market and achieve stable investment returns. Hurrying to act is the beginning of failure. The best investors are those who can patiently wait for the market to give clear signals.